Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis and recommendation on Opendoor Technologies. Is this the disruptive real estate tech company that you should invest in right now? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term investors out there. And as always, folks, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you'd like to hear daily stock reviews and recommendations. So let's get right into it. So Opendoor Technology operates a digital platform for residential real estate that enables consumers to buy and sell their home. Home sellers can use the company's mobile application or website to request a competitive cash offer online. Home buyers can likewise utilize its app or website to self-tour or virtually tour homes at their convenience, shop for financing, submit an offer, and close on their timeline. It acquires homes directly from individual sellers and resell those homes to buyers, including both individual consumers and institutional investors. Upon acquiring a home, it typically makes necessary renovations and repairs before listing it for sale on its website, its mobile app, multiple listing service, and other online real estate portals. It also offers adjacent services including title and escrow, Opendoor home loans, list with Opendoor, and buy with Opendoor. It started back in 2014, and its co-founders included tech veterans like Eric Wu, Keith Robois, and Ian Wong. Now, Robois was a former executive at PayPal and Square, while Diwu sold the company to Trulia, and Wong had worked as machine learning pro at Square. The idea of Opendoor is definitely an innovative and disruptive to the real estate industry. They wanted to completely rethink the residential real estate transaction processes. Just like Zillow's Zestimate, Opendoor made it possible for anyone easily determine, or more like estimate, the value of their home, get financing, conduct an inspection, experience a video walkthrough, and handle the processing of title and escrow, all through a mobile app. Now, the mobile app also gives homeowners the ability to sell their homes within a few days without even listing it with a traditional agent. In those situations, Opendoor itself buys the homes with cash. Since this is a streamlined process, the seller's overall costs are slightly cheaper with Opendoor purchasing the home. Now, the company did go public through the SPAC, which is a special purpose acquisition company. In other words, Opendoor merged with a public traded shell company. The process was faster than a traditional IPO, but has also enabled the company to obtain capital. Now, let's go ahead and look at some news of the company. So recently, it announced just a few days ago that it proposed a public offering of common stock of 24 million shares, with underwriters over allotment of about 4.3 million additional to that. So at $27 a share for expended gross proceeds of $770 million. The closing of this is going to be February 9th in 4 days. So Opendoor intends to use the net proceeds from this offering to invest in increasing existing market penetration and to expand into new markets and for working capital and general corporate purposes. Now, let's go ahead and look at some of the fundamentals of the company. It's currently trading at $26 a share right now, and it has a current market capitalization of about $15.74 billion, which is about half of Zillow, or about. You have to look at that right now on today. So the company's projected revenues for 2020 should be around $2.5 billion, with negative earnings of $256 million. That's for 2020. Now, the company is forecasted to remain unprofitable over the next 3 years, unlike Zillow and Redfin right now, who are very profitable, even though revenue is forecasted to grow about 38% per year. It's forecasted to become profitable by 2025 with $19 billion in revenue, with an estimated $159 million in earnings. Now, looking at the company's financial strength, its short-term assets of $923 million exceed its short-term and long-term liabilities. Now, the debt level, debt-to-equity ratio of 40% is considered high, but it does have a stable cash runway, though. While unprofitable, the company has sufficient cash runway for more than 3 years if it maintains its current positive free cash flow level, and its forecasted cash runway looks good as well. Now, insiders have only bought shares in the past 3 months to the tune of 2.5 million shares by Access Industries. Let me bring it back over here. So what do the analysts say about this? Now, the current analyst consensus is a buy, with 66 a strong buy and 33% a hold. The average stock price target over 12 months is $32.50, with a high estimate of $34 and a low estimate of $31. Now, going over a couple of analyst reports, well, I didn't find a single analyst report actually going into detail on Opendoor Technology. So in my buy, hold, or sell recommendation on Opendoor Technologies, here are my thoughts. Now, besides the pros of the company that I discussed earlier in the video of what the company is about, the lure of Opendoor stock is the company's massive market opportunity. According to the company, the residential real estate category is the largest undisrupted market in the United States, valued at a whopping $1.6 trillion. The current real estate market is highly fragmented right now. There are about 2 million agents out there, and over a quarter of them have other jobs. So do I think Opendoor can grab a large amount of market share? Yes, I think they can. But we also have to look at the downside risks to the company as well. If overall economic conditions were to start slowing, if the housing market deteriorates in the future, or if foreclosures ever happen. Now, I do not see economic conditions over the next year deteriorating. I surely don't see the housing market deteriorating over the short term, nor because of government regulations that pause foreclosures either. Now, the housing market will eventually cool down, and one day we will be in the buyer's market again. Foreclosures will surely stack up, but that will take a few years at least. So for the short term, I don't see those forces having a direct impact at this exact moment in time. Now, looking at the competitive environment, it is getting more tense for this company. The direct competitors for Opendoor are Zillow, which have gained significant ground in this sector and offers a broader range of services, and also Redfin has a strong momentum as well. I do know of other companies wanting to get into this sector specifically with varying business models, which I've already reviewed in earnest already, most of which could be extremely capital intensive, to say the least. The smaller companies would need to raise an immense amount of capital to compete direct head-on with Opendoor, Zillow, and Redfin of the world. So another big issue with Opendoor at the moment is its growth engine has basically reversed itself because of the pandemic. The company itself plunged around 48% in 2020, and it probably will take a few years to rebound. Now, the company's first quarterly report as a public company is coming out on March 4th. That's about a month away. Some investors should wait till then to properly evaluate the risk of Opendoor by checking their financials. Now, Zillow and Redfin are also profitable right now, but Opendoor is not. So Zillow and Redfin are profitable. They earn revenue via agent fees and other mortgage services, in addition to their growing presence in the cash offer direct buy space compared to Opendoor, which is almost completely reliant on the new model and is yet to reach a profitable scale. Now, I am a short-term speculative buy recommendation on this company at the moment. I do think in the short term there might be some upward potential, but here's a warning. The current valuation of over $14 billion, I think this stock has already gone to the moon, and there's far more downside risk, upside potential for the long-term growth investors out there with this company in the future at this exact moment in time. This stock is only for the very speculative and aggressive investors. Safer bets would be to buy into Zillow and Redfin. The negative real interest rate environment should theoretically support speculation into equities right now and continue some short-term momentum in this stock, but in the long run, it could turn on a dime. I question the long-term sustainability of this hype in the stock right now. Also, you should be watching delinquency rates like a hawk. Key economic indicators will let you know when you should unload your position in Opendoor. That's why I'm not a long-term bull on this stock, is I think in the future, in the next couple of years, there will be a downward trend in the industry. And that's when you have to look at those indicators and say, okay, well, I'm going to take my profits at a certain point in time in the future. Now, I would recommend if you like this company, to place small positions not only in Opendoor but also in Zillow and Redfin, and access it in 6 months to a year and reevaluate and see which actually gave you the biggest bang for your bucks. So the company has gotten off on a nice start as a public company. So we'll see how it goes in the future. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you like to hear daily stock reviews and recommendations. Until the next stock update video later today, folks, ciao.